A few weeks ago, I visited a big hospital in Gurgaon where a friend of mine had been admitted for surgery. I was relieved to discover that the surgery had gone well and that he would be discharged in a week or so. But as I stepped out of the hospital, I looked at the massive machinery that the hospital was: extensive infrastructure, countless people, super busy staff, multiple treatments, several departments, and so on. Now, despite this complexity, the whole system worked like a well oiled machinery, as if everything was on autopilot. As I sat in my car, I felt happy that such superior healthcare facilities exist today. But my analytical brain also got active. If hospitals are so critical to modern life, enjoy inelastic demand, and work so efficiently, wouldn't hospital stocks make an excellent investment? And that's what we will try to find in this video. Hello and welcome to ET Money's YouTube channel. In this video, we will compare the three largest hospital stocks: Apollo Hospitals, Max Healthcare, and Fortis Healthcare. Now, this video belongs to our playlist on company analysis and comparisons. You can explore it if you want to watch more such videos. The link is in the description. Now, we'll compare these hospitals across multiple perspectives so that you can get a comprehensive understanding. Let's first see how these three hospitals compare in terms of their businesses. But before that, here's something useful. You can now get cash to enjoy your present while staying invested for your future with loans against mutual funds on the ET Money app. The interest rate is just 10.75% per annum and there is no fixed EMI. Pay interest monthly and repay the principal amount whenever it is convenient for you. Plus, there is no need for a CIBIL score. So go ahead, check your eligible limit on the ET Money app. First, let's take a look at Apollo Hospital's business. Apollo has three businesses: healthcare services, diagnostics and retail health under Apollo Health and Lifestyle, and digital health and pharmacy distribution under Apollo Healthco. Its healthcare services comprise 73 hospitals across the country with 9,463 operational beds. Now, in terms of revenue, in Q1 FY26, healthcare services comprised 50% of the total revenues, while 42% came from digital health and pharmacy distribution. However, digital health and pharmacy distribution are low margin businesses, so their contribution to the bottom line is just 13%. Now, the company's diagnostic and retail health business is loss making at the PAT level. So, a major share of the company's profits comes from the hospital's business only. Next, let's talk about Max Healthcare. Now, unlike Apollo's pan-India presence, Max Healthcare's hospitals are focused in Delhi NCR. Of its 22 hospitals and medical centers, 14 are in Delhi NCR. The hospital's operational bed capacity stands at about 4,700. Now, apart from its hospitals, Max also has a diagnostics and pathology business under Max Lab and a home healthcare service business under Max at Home. However, these two businesses are quite small as compared to their main business. As against the company's net revenue of about 1900 crores in Q1 FY26, Max Lab's net revenue stood at just 48 crores or 2.5%. And as against the company's gross revenue of 2028 crores, Max at Home generated 60 crores or just 3%. Finally, let's look at Fortis Healthcare's business. Fortis has two business verticals: hospitals and the diagnostics business under the brand Agilis. It has 33 healthcare facilities across the country with over 5,700 operational beds. Now, in Q1 FY26, the company's hospital business generated revenue of about 1,800 crore and its diagnostic business generated revenue of about 370 crores. Overall, all three companies, Apollo, Max, and Fortis, have similar business lines apart from their core hospital businesses. Even in terms of revenue mix from the treatments, there are quite a few overlaps, with oncology, cardiac sciences, orthopedics, neurosciences, renal sciences being the top contributors to the revenue mix. Now, in terms of number of hospitals and operational beds, Apollo is the largest, followed by Fortis and Max. Notably, while Apollo and Fortis have pan-India focus, Max is focused only on the Delhi NCR region. Okay, let's next compare the three hospitals across some sectoral metrics. But before that, please subscribe to this channel if you haven't already and press the bell icon so you never miss a video from us. The first key metric is ARPOB, that is average revenue per operational bed. ARPOB tells us what revenue a hospital earns per bed. Naturally, the higher this number, the better. Max is at the top in ARPOB over the last 5 years, though its ARPOB has fallen in FY25 due to new capacity addition. Now, without new hospitals, its ARPOB is 83,000 per day instead of 73,000. On the other hand, Apollo and Fortis's ARPOB stands at about 61,000 and 66,000. The next key metric is average length of stay or ALOS. ALOS tells us how many days a patient spends in the hospital on average. The smaller this number, the better. And that's for two reasons. First, a shorter stay at the hospital indicates greater efficiency and effectiveness of treatment. 2. Hospitals typically earn most of their revenues during the first few days of admission when the patient undergoes tests, treatment or surgery. Post that initial period, the revenue from the patient tends to fall. Now, Apollo Hospitals has done very well here, followed by Max. Fortis's ALOS has increased in FY24 and FY25. Then comes the occupancy rate. This metric tells us what percentage of a hospital's bed are occupied during a period. Naturally, the higher this number, the better. Max is at the top for this metric, with its occupancy rate being over 70%. Apollo and Fortis have yet to cross that mark. The next key metric is CAPEX as a percentage of revenue. CAPEX or capital expenditure is a key growth indicator in the hospital industry. For a hospital to grow, it must incur capital expenditure on infrastructure and equipment. This makes CAPEX a proxy for growth in this sector. Now, in terms of net CAPEX to growth sales, Max Healthcare is at the forefront, with its CAPEX rising from 5% in FY21 to 14% in FY25. Fortis comes next. Its CAPEX has risen from 5% to 11%. Finally comes Apollo, with its CAPEX rising from 3% to 8%. The last important metric is related to the one we just saw. Due to their high CAPEX requirements, hospitals have to resort to debt. But a very high share of debt in the capital structure can be a problem. The debt capitalization ratio is a relevant metric to assess the amount of debt in the capital structure. This ratio is derived by dividing the total debt by the sum of total debt and equity. This ratio tells us what percentage of a company's capital structure is debt funded. Now, among Apollo, Max and Fortis, Apollo's debt capitalization is the highest, while Max and Fortis have lower numbers. However, this ratio has steeply risen for all three companies in the last 2 years, which suggests that all three hospital chains have resorted to debt to fund their expansion. Now, in absolute terms, the debt capitalization ratios for all three hospitals are in a manageable zone and aren't a concern as of now. Should this ratio cross 50%, that's a sign of trouble, so keep a watch. Alright, let's now compare the key financials of the three hospitals. First, let's take a look at the three hospitals' revenue over the last 5 years. In absolute terms, as of FY25, Apollo's revenue was almost 3 times that of Max and Fortis. In terms of revenue growth, Max is at the top with a 3-year and 5-year growth rates of 21% per annum and 45% per annum respectively. Apollo comes second in terms of revenue growth, and then comes Fortis. Next comes profit after tax or PAT. Here also, as of FY25, Apollo is bigger than its peers, but the gap is narrow. But in FY23 and FY24, Max reported a higher profit than Apollo. In FY21, the COVID year, when both Max and Fortis reported losses, Apollo managed to turn a profit. Now, in terms of profit growth, Max is again at the top across both 3 and 5-year periods. Fortis's profit growth is quite subdued over the 3-year period. Okay, next comes EBITDA margin. EBITDA stands for earnings before interest, taxation, depreciation and amortization. EBITDA margin is a profitability metric derived by dividing EBITDA by the total revenue. The higher it is, the better. Here, Max is the undisputed leader, and this high margin is the reason for its comparatively better profitability in spite of lower revenues than Apollo's. Over the last 5 years, Max's EBITDA margin have averaged 27.5% compared to Apollo's 13.5% and Fortis's 17.8%. Then comes ROCE or return on capital employed. ROCE is also a profitability metric. It is derived by dividing EBIT or earnings before interest and taxes by capital employed, which includes both equity and debt. Now, for companies whose business entails taking debt, ROCE is a better metric than its cousin ROE or return on equity. Here, over the years, Apollo has been the winner with its 5-year ROCE at 18.5%. Fortis's average stands at 11% and is the least among the pack. At 12.2%, Max is in the middle. Finally, let's check the free cash flow for the three hospitals. Free cash flow is obtained after deducting the capital expenditure or capex from cash flows from operations. It indicates the money that is left after all operating and capital expenditures have been taken care of. In other words, it indicates capital that can be safely taken out of the business without affecting the company's operations. Free cash flows can be used for reinvestment or to pay dividends or buy back stocks or for acquisitions. For capital intensive sectors like hospitals, a positive free cash flow indicates efficiency of operations. All three hospitals have a history of free cash flow generation. To put things in perspective, their free cash flows can be compared with the revenue. Fortis and Max fare better on this measure than Apollo, with their FY25 free cash flow to sales at 7.6% and 7% respectively, against Apollo's 2%. Now, if you're wondering where to get all this data, worry not. We have got you covered. On the ET Money app and website, you can find the financial information and plenty of analytical data for Apollo, Fortis and Max or for any other listed company. Just type the name of the company you're researching in the search bar and hit enter. This brings us to the next section, stock metrics. Let's first take a look at the stock price returns of the three hospitals over the medium to long term. Over the 3-year period, Fortis has proved to be most rewarding, followed by Max and Apollo. Apollo has stayed behind even the BSE Healthcare Index. Over the 5 years, Max is ahead of Fortis and Apollo. All three companies have beaten the benchmark too. Over the 7 and 10-year periods, Apollo has done the best. Since Max Healthcare was listed only in August 2020, we don't have 7-year and 10-year returns for it. Broadly, all three hospitals have generated handsome returns for investors and have stayed ahead of the benchmark. Next, let's compare the dividend payout ratio. Now, the dividend payout ratio tells us what percentage of profits a company gives away as dividends. The higher the ratio, the more the share of profits given to the shareholders. Apollo is a clear winner here. Its dividend payout ratio has ranged from 16% to 29% over the last 5 years. On the other hand, Fortis and Max started giving dividends only in FY23. Fortis' dividend payout has ranged from 10% to 13% and Max's from 9% to 14%. Finally, let's check the valuation of the three stocks across three parameters: price to earnings, price to book, and EV to EBITDA. Now, in terms of PE ratio, Max is the most expensive and Apollo is the cheapest in relative terms. As compared to their own historic medians, Apollo is cheaper. However, in terms of the PB ratio, Fortis is the cheapest, but it's quite expensive as compared to its own historic median. Apollo is the cheapest in terms of premium to the median PB. Finally, in terms of EV to EBITDA, Apollo is the cheapest both in relative terms and as compared to median valuations. Now, EV to EBITDA ratio is used to assess a company's valuations irrespective of the capital structure. It's especially useful for evaluating companies whose capital structure can have high debt. Now, EV stands for enterprise value. It is the theoretical cost of acquiring a company. It is derived by adding up the market cap and total debt and subtracting cash. Overall, Apollo is the cheapest among the three across valuation metrics. Okay, let's pull all the findings of this analysis together in the concluding section of the video. On your screen is a summary of how the three hospitals fared on the metrics discussed. You can use this table and combine it with your own research to finalize the best hospital stock for your portfolio. Do let us know which hospital stock you like the most. Alternatively, you can analyze the metrics discussed in this video for other hospital stocks to widen your research basket. And with this, we have come to the end of this video. I hope you found it useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.